I mean, how is it mathematically possible for the technology sector to jump nearly 20% in a single 30-day period, while the literal energy powering those very servers is rapidly sinking at the exact same time?
Right? It's a massive contradiction. And
Yeah.
honestly, it reveals a market that is deeply fragmented beneath this, very calm surface.
Yeah. Well, welcome to a new deep dive. Today, our mission is to decode a really comprehensive stack of market data and macroeconomic reports from May of 2026.
We're pulling from a few places here.
Exactly. We are looking at official FRD economic indicators, so that's measuring GDP, the consumer price index, Fed funds data, right alongside an Alpha Frame Analytics market snapshot.
Which is great because that snapshot covers everything from, geographic ETFs and stock sectors to commodities and volatility.
Right. And just to set the stage for you listening, our goal here is not to issue financial advice.
Definitely not.
We want to take these dense institutional grade numbers and, well, translate them into a clear framework of the current economic regime. We want to understand the hidden mechanics pushing and pulling on global capital and, by extension, your own portfolio.
Because when you see tech stocks launching to the moon while oil prices just fall through the floor, there's a really complex structural story hiding under the hood.
Yeah, so to understand these soaring stock prices, we actually have to step back. Let's examine the underlying engines driving them by comparing the foundational economic realities of the United States versus the Eurozone.
You always have to start with the macroeconomic bedrock. I mean, the differences in growth and inflation between these two regions, that's what dictates the flow of trillions of dollars.
Right, so let's lay out the U.S. metrics first. In the first quarter of 2026, real GDP in the U.S. grew by a pretty healthy 2.6% year over year.
Very solid.
Yeah. And core inflation, so the core CPI, which strips out those highly volatile food and energy prices, that's sitting at 2.7%. Meanwhile, the Federal Reserve's benchmark interest rate is holding steady at 3.64%.
Which, paints a picture of an economy operating in a fairly stable equilibrium.
Right.
Growth is robust enough to sustain employment, inflation is slightly elevated but no longer spiraling, and the central bank is basically holding the policy rate at a level that keeps a lid on prices without suffocating corporate activity.
Okay, but then we look at the data from across the Atlantic, and the math just stops making sense.
It really does.
Yeah, the Eurozone's Q1 GDP growth is incredibly sluggish, just 1.0% year over year. Yet their inflation, which they measure by the Harmonized Index of Consumer Prices, is actually running hotter than the U.S., sitting at 3.0%.
Right.
And here is the data point that just demands an explanation. Despite this higher inflation, the European Central Bank's deposit rate is significantly lower than the Fed's. It's sitting at just 2.0%.
It is a textbook central banking nightmare. The ECB is currently trapped in a stagflation pressure cooker.
Stagnant growth combined with persistent inflation. I was trying to visualize this divergence, and it's like watching two cars on the highway.
Okay, I like that.
So the U.S. is cruising in the center lane at a steady 65 miles per hour. The engine is humming, the internal temperature is totally fine. But Europe is sputtering along in the slow lane at 30 miles per hour. And somehow smoke is pouring out from under their hood because their engine is running way hotter with that 3.0% inflation.
That's a great way to look at it.
So how did Europe get trapped here? I mean, if growth is a sluggish 1%, where is that inflation even coming from? It can't be from massive consumer demand if the economy is stalling.
No, it's not. And that is the crucial distinction between demand pull inflation and supply side inflation.
Okay, let's unpack that.
So in the U.S., inflation was largely driven by a booming economy and high consumer demand. But in Europe, that 3.0% inflation is heavily influenced by structural rigidities and supply chain vulnerability.
Like energy.
Yes, particularly around energy imports and fragmented labor markets. They are basically importing inflation while their domestic economic engine just stalls out.
Which explains the central bank's paralysis, right?
Literally.
If the ECB aggressively hikes interest rates from 2.0% to match the Fed and crush that inflation, they risk completely stalling out that fragile 1.0% GDP growth.
Right. They could easily tip the entire Eurozone into a severe, prolonged recession.
Wow. And the U.S. Federal Reserve has the luxury of that strong 2.6% growth rate, so they can afford to keep rates at 3.64%.
Precisely. The ECB simply does not have that luxury. They have to tolerate a slightly hotter inflation rate just to keep their economic engine from completely seizing up. And this divergence in central bank policy, it creates a fundamental gravity for global capital.
Because capital flows to where is treated best.
Always.
So if the U.S. has a higher interest rate acting like a magnet, combined with stronger organic growth, that creates a really powerful draw.
Right. But money doesn't just sit in a vault earning the overnight rate.
Yeah.
It actively hunts for yield.
Right. So knowing that these two Western economic engines are running at vastly different temperatures, where is that restless capital actually going?
Well, when we transition from the macroeconomic foundation to broad market returns in the alpha frame data, we see that capital flowing into very specific risk pools.
Let's look at those major indices. So the S&P 500 had a very strong May, up 6.4%, bringing its trailing one-year return to 24.7%.
Massive.
Yeah. And MSCI Europe, which perfectly mirrors that sluggish GDP data we just dissected, trails slightly. It was up 3.3% for the month and 15.8% for the year.
Makes sense given the macro backdrop.
But the major anomaly here, the major surprise in this data set is the MSCI Emerging Markets Index.
Oh, yeah.
It absolutely crushed the developed world. It returned 8.3% in May alone, and over the past year, a staggering 43.4% return.
It is dominating the risk and return scatter plot right now. Highest return, but inevitably the highest volatility.
All right, so if you're listening and looking at your portfolio right now, what is the catch for you? I mean, if the S&P 500 is the reliable veteran athlete who consistently hits doubles, emerging markets look like the rookies swinging for the fences and hitting grand slams every single game.
But they strike out a lot.
Exactly. This level of outperformance implies terrifying volatility, doesn't it?
It implies massive systemic risk. But to understand why institutional capital is suddenly so willing to embrace that terror, to just pour money into emerging markets,
Yeah.
you have to look closely at the U.S. yield curve.
Okay.
The FRED data shows a completely flat yield curve right now. The 2-year and the 10-year U.S. Treasury yields are virtually identical.
Wait, so the spread is literally 0%.
Exactly zero.
Let me synthesize what that actually means for the plumbing of the financial system.
Go for it.
If I'm a bank or a major institutional investor and the U.S. government is paying me the exact same interest rate to lock my money up for 10 years as they are for 2 years.
Why would you take the 10-year deal?
Right. I'm absolutely not going to take that 10-year duration risk. The term premium, the reward for parting with my money for a decade, has completely vanished. Is that why institutional money is getting so restless?
You hit the nail on the head. I mean, traditional portfolio construction relies on that term premium. When the yield curve goes flat, safe, long-term bonds stop acting as an engine for portfolio growth.
So they have to look elsewhere.
Exactly. Portfolio managers are forced to look outward. Capital flows out of the safety of the Western bond markets and goes hunting for higher risk premiums in riskier geographies.
They are forced out on the risk curve just to meet their return targets.
Yes. Emerging markets offer that higher yield, but the huge catch is volatility clustering. Meaning these markets are extraordinarily sensitive to a sudden strengthening of the U.S. dollar, geopolitical shocks, or localized liquidity crises.
Right.
It is high reward, but if the global macroeconomic mood suddenly shifts from greed back to fear, that 43% gain could evaporate in a fraction of the time it took to accumulate.
Which brings us to the next layer of this puzzle. Because following the flow of capital, it's not just geographical risk that investors are taking.
No, not at all.
When we look back at the West, specifically beneath the surface of the S&P 500's strong 24.7% annual return, we find something even more extreme.
Yeah, the concentration.
Exactly. The broad market looks incredibly healthy, but peeling back the layers reveals that the heavy lifting is being done by one very specific, highly concentrated muscle.
The absolute dominance of the technology sector.
U.S. tech was the single best performer of the entire month across all asset classes. It skyrocketed an unbelievable 19.8% in May alone.
In 30 days.
Unreal. European tech followed closely with a 16.9% gain. But the metric in this report that frankly stopped me in my tracks is the one-year Sharpe ratio for U.S. tech.
It's absurd.
It sits at a massive 2.41. And, for those tracking at home, the Sharpe ratio measures your risk-adjusted return. It tells you how much excess profit you are getting for every unit of stomach-churning volatility you have to endure.
Right, and normally, anything over 1.0 is generally considered a fantastic investment.
So finding a broad sector carrying a 2.41 Sharpe ratio over a full calendar year is staggering.
It really is. It basically means investors crowding into technology are being heavily rewarded with almost no meaningful drawdowns to test their conviction.
But I have to contrast this tech exuberance with the month's biggest losers, because this is where the contradiction we mentioned at the start really takes shape.
Let's hear it.
While tech was up nearly 20% in 30 days, U.S. energy dropped 5.6%. EU healthcare fell 5.5%. And Brent crude oil was the worst overall performer of the month, down 6.9%.
Divergence is key.
Right. I mean, a Sharpe ratio of 2.41 in tech sounds like we found a magical unicorn, but isn't a 20% sector jump in 30 days a blaring warning siren of concentration risk? When does a boom become a dangerous bubble?
It absolutely is a siren. When an overwhelming majority of global capital crowds onto one side of the boat, the risk of that boat capsizing increases exponentially. However, there is a deeply mechanical relationship at play here between soaring technology stocks and sinking energy assets. They aren't acting independently.
They aren't.
No, they are part of a causal loop.
I want to dwell on this because it feels like the defining insight of the entire data stack. These two sectors seem like polar opposites. How does a software or AI company benefit from the collapse of crude oil?
They are tethered together by inflation and discount rates.
Okay.
Remember our macroeconomic foundation from earlier. Core CPI in the US is at 2.7%, and the Fed is holding rates at 3.64% to ensure it doesn't spike again.
Right, keeping a lid on it.
Exactly. Now, what happens to the broader economy when Brent crude oil drops nearly 7% in a single month and the entire energy sector bleeds out?
Well, the input costs for everything go down. The cost of manufacturing, shipping, aviation, fueling supply chains, all of it drops.
Correct. Falling oil prices act as a massive deflationary anchor on the economy.
Ah, I see where this is going.
Right? Because energy prices are aggressively dragging down the headline inflation numbers, the bond market begins to price in the certainty that the Federal Reserve will not have to raise interest rates any further.
In fact, they might even cut them.
Exactly. And what sector of the stock market benefits the absolute most from the expectation of lower interest rates?
Technology. Because tech valuations are inherently forward-looking.
Yes.
They are long-duration equities. Their current stock prices are largely justified by massive profits they expect to earn 5 or 10 years out in the future.
Right.
So when interest rates fall, the mathematical discount rate applied to those future profits shrinks, making those future dollars infinitely more valuable today.
That is the exact mechanism. The financial struggles of the energy sector are quite literally subsidizing the monumental rally in technology.
That is wild.
By suppressing headline inflation, crashing oil prices are keeping the discount rate low enough for tech multiples to expand to the moon.
It is totally bizarre when you lay it out like that. I mean, a booming AI company in Silicon Valley actually relies on the misery of an oil driller in Texas to keep macroeconomic interest rates low enough for their stock to soar.
It is a functional causal loop right now, but it is incredibly fragile. Think about the reversal.
Okay, let's say energy turns around.
Right. If geopolitical tensions rise or supply gets constrained and energy prices suddenly spike, inflation expectations will instantly rebound.
Which means interest rate expectations will rise in tandem.
Exactly. The discount rate applied to those future tech earnings goes up, and that beautiful 2.41 Sharpe ratio could violently and rapidly reverse.
Wow. So with tech flying dangerously close to the sun on the wings of cheap oil and emerging markets absorbing billions in restless capital, we really need to look at the market's safety nets.
We do.
If this causal loop is as fragile as you say, we need to examine the fear indicators to see how institutional investors are really positioning themselves beneath this surface-level exuberance. Let's talk about volatility and safe havens.
And this is where the alpha frame data gets truly contradictory and, frankly, a bit ominous.
Yeah, first let's look at the VIX. So this is the implied volatility index on the S&P 500, widely known across the industry as Wall Street's fear gauge.
Right.
It is currently sitting at 15.3. Now, according to the historical percentiles in the data, this is categorized as moderate.
Very moderate.
Yeah, it's sitting at only the 23rd percentile over a 5-year look back. So the options market appears remarkably calm. No one is paying a premium for downside protection.
A VIX at 15 basically suggests that equity investors are perfectly comfortable. They believe the current economic regime is stable, and they aren't pricing in any immediate tail risks or market crashes.
And we see a similarly boring story in traditional safe haven bonds.
Mm-hmm.
Eurozone government bonds provided a slight positive return of 1.3% for the month. The euro to US dollar exchange rate is hovering relatively flat at 1.165. Everything looks sleepy.
Until you look at precious metals.
Right. Then that illusion of calm completely shatters.
Utterly shatters.
Gold took a tiny step back for the month, down 0.6%, but remains up a massive 34.2% for the year. That alone is a huge move for a safe haven. But
Silver is the crazy one, yeah.
silver is the absolute wild card in this entire report. It was up 3.9% in May and a staggering 101.6% over the last year.
A 100% annual gain on a physical, non-yielding metal is an extraordinary macroeconomic signal.
I mean, silver is acting like the quiet, younger sibling to gold who suddenly woke up, decided to run an ultramarathon, and beat all the professional athletes.
That's a fun way to put it, yeah.
Here's what I want you to explain to us. If the VIX fear gauge is snoozing at 15 and tech is partying like there's no tomorrow with 20% monthly gains, why are institutional investors quietly hoarding a safe haven metal like silver to the tune of 100% annual gains?
Well, what you are observing in the silver market are the deep footprints of institutional hedging. On the surface, the headline data feels incredibly risk-on. Retail and algorithmic capital buys tech, buys emerging markets, and ignores the VIX. But massive institutional money sovereign wealth funds, global asset managers, they don't just blindly ride the trend.
They mathematically hedge against tail risks.
Precisely.
So they aren't just betting on tech to win, they are simultaneously buying cheap insurance for that rare 1 in 100 doomsday scenario. A tail risk just in case this whole fragile tech energy loop collapses.
Exactly. And silver serves a very specific purpose in that hedge. It has a unique dual citizenship in the global market, if you will.
Dual citizenship?
Yeah, on one hand, it is a monetary safe haven, much like gold, right? Utilized to protect purchasing power against structural inflation or currency debasement.
Right.
But on the other hand, it is a highly demanded industrial metal. It's heavily consumed in the manufacturing of the very technology, solar panels, and electronics that are currently booming.
Oh, that's fascinating. But why is it outpacing gold so aggressively? Gold is up 34%, which is great, but silver is up over 100%.
Because of beta. Silver has a much smaller aggregate market capitalization than gold.
Okay, let me put that in conversational terms. Silver's market is much smaller than gold's. It's like a small boat on the ocean compared to a massive cruise ship.
Exactly.
So when a massive wave of institutional money hits both of them, the small boat swings much more violently.
That's the beta at work.
That volatility, or higher beta, is what gives you those 100% returns on the upside, but I'm guessing it also carries massive downside risk.
It does. It's a perfect analogy. When institutional money moves into precious metals as a hedge against central bank policy errors.
Like the ECB being trapped with high inflation and low growth.
Yes, or the Fed keeping rates too high for too long. When that happens, silver's higher beta causes it to reprice much more aggressively than gold.
So what is the smart money actually afraid of if the stock market's fear gauge doesn't show it?
They are looking squarely at that completely flat yield curve we unpacked earlier.
Right, the vanished term premium.
Historically, a flat or inverted yield curve is a very reliable precursor to a macroeconomic regime shift. It signals deep structural uncertainty about the long-term prospects for economic growth.
So they're looking at the chessboard and seeing vulnerabilities everywhere.
Right. Institutional money is surveying a world where U.S. equities are dangerously concentrated in a single sector whose valuation depends on cheap oil, while Europe is structurally sputtering with stagflation.
And so they hedge.
They are quietly accumulating precious metals because they foresee a scenario where inflation proves stickier than expected, forcing central banks to eventually devalue currency just to manage mounting sovereign debt.
So the low VIX is just the calm surface of the water.
And the 100% surge in silver is the violent rip current underneath.
Man, that is eye-opening. So what does this all mean when you look at your own portfolio?
Well,
When you open your brokerage app or you read a financial headline that just casually says, the market was up today, you now know that the reality is far more complex than a single green arrow.
it really is a massive, multi-directional tug-of-war beneath the indices.
Exactly. On one side, you have soaring technology stocks and high-flying emerging markets, entirely driven by capital desperately hunting for yield in a world where the bond yield curve has gone flat. On the other side, you have struggling real-world commodities like energy, which are ironically acting as the deflationary anchor, keeping the inflation numbers just low enough to allow that very tech boom to happen.
It's all connected.
And underneath all of that noise, silent, high-beta hedges in precious metals are flashing massive warning signs that the smartest money in the room is quietly preparing for the weather to change.
And, true financial literacy is the ability to see these underlying mechanics.
Yeah.
The headline index number is basically designed to hide the massive sector rotations, the yield curve plumbing, and the localized volatility occurring just beneath the surface.
Which leaves us with a final lingering contradiction to ponder for you listening as we wrap up today. We currently have a remarkably flat yield curve, which historically screams that there is deep systemic uncertainty among bond investors about our long-term economic future.
Right.
Yet at the exact same time, we have an equity VIX fear gauge sitting at 15, showing that stock market investors are utterly fearless and unhedged.
The great disconnect.
So are we entering a genuinely stable, tech-driven new era where the old rules of economics no longer apply? Or is the broader market currently driving 100 miles an hour down the highway while completely blindfolded by recent gains? What will happen to everyday portfolios when those two conflicting realities finally collide? The X-ray machine of this economy might not be broken, but it's definitely showing us a picture we've never quite seen before.
And that inevitable collision between the bond market's warning and the stock market's exuberance, that is what every serious portfolio manager is quietly waiting for.
Incredible stuff. Thanks for joining us on this deep dive. Until next time.